There is one issue at the epicenter of global markets. Bond markets screaming for a rate cut. Will the Fed follow up?
To start with, the RBA typically moves a couple of times.
They were the second. The New Zealanders have already gone.
On the PBOC, obviously, we do expect further easing.
And yes, it probably has to be the Fed that we have to focus on next.
The market's already priced for 3 rate cuts.
They could cut rates quite a long way.
That idea that central banks are going to cut rates as that growth outlook weakens.
Are they going to be preemptive? Are they going to take out some kind of insurance about more of a downturn in growth? Or are we sliding into a recession and therefore we need the full rate cutting cycle and we need to maybe take rates slightly negative or certainly towards zero?
So we've heard so much dovish rhetoric over the last few months through 2019. We have seen very little action, Karen. We have seen the Reserve Bank of New Zealand cut rates, the Aussies cut rates this morning. Do we begin a rate-cutting cycle? Do you think we do?
I think this is absolutely central. If we try and square why the equity market isn't down further on the back of this trade news, I think the way we can do that is by looking at the bond market, which says the Fed are going to do the heavy lifting to keep the US show on the road. And they are going to cut rates preemptively, aggressively at the first sign of trouble. That will really cushion the US economy. So regardless of what the US administration is doing with trade, the US economy stays solid. That supports the equity market. Now, if that is wrong, if we find out that the Fed are not willing to do that, that actually they think that your current data are fine, and there's really no clear evidence of such a preemptive, aggressive stance, then I think we do have some concerns in terms of allocation here.
Well, the chairman speaks in around about 20 minutes' time, 10, 15 minutes' time. Jordan, we've heard very little from FOMC policymakers that are signalling they're going to deliver what ultimately this market is priced for.
We've had one. We had Bullard last night, but Clarida,
Does
Evans...
he count?
He's the dove of the doves, so he does count because he tells you where the extreme's going, and at least it's that direction. It'd be more worrying if it wasn't, let's just say that. But if Jerome Powell, in less than 20 minutes' time, if he opens the door, then, as Karen said, equities should... Well, to be honest, it's all bad news in terms of trade, in terms of policy, in terms of growth, but at least there's a risk-supportive aspect there. If it's patience, if it's we're not doing anything, that's the behind-the-curve Fed policy pricing. So there'll still be cuts priced in, but equities and risk assets will go, we're not getting it for a while.
James Athey?
Yeah, I mean, the problem that you've got is that the situation that Karen describes there, where Jay Powell says, hey, look, the data isn't there, risk assets fall out of bed, and we know that, unfortunately, the Fed spends more time looking at financial markets than it does at the economy. So for me, they're looking in all the wrong places for all the wrong things, as they have been for 10 years. And this global cutting cycle, we've been here before. When Janet Yellen said they were going to do 4, and then she panicked in Q1 in 2015, did none, that caused a dollar sell-off, that caused all current account countries with currency needs to rally, and they had to cut, and you race to the bottom. And we're going to play that game again.
So what is the catalyst for reconciliation right now between the market and the Federal Reserve?
I think it's very difficult. You've seen that in the bond and equity market performance this year. They've essentially gone in very different directions. You've had the jaws of the crocodile going wider and wider because the only thing keeping equity markets afloat essentially is easy money. Well, we're running out of road. If the Fed wants to do 50 or 75 when they've got unemployment at 3.8% and inflation at 1.8%, then what do they do in a recession? So you've got a very, very difficult problem now whereby the Fed has waited too long to tighten. It's then tightened too quickly. It's scared markets, and now it's dealing with the after effects of those repeated policy actions.
Karen, you've heard this argument before. We've all heard this argument. I wonder what you make of it. It's the argument that essentially we are south of 4% on unemployment. Wage growth is OK. Growth is still in and around 2 and 3%. Maybe we return to trend. It might not get worse. Why cut rates? That is one argument out there. What's your response to it?
Well, I think, on the economic data, then you're absolutely right. On the current economic data, there's nothing telling you need to cut rates right now. I think the Fed's decision it needs to make is preemptively how much damage do I think this trade war is going to do to global growth and the US. But there's another factor in play here, which is I think the Federal Reserve have to be very careful about a political narrative evolving, which is that the Federal Reserve are not a US champion, that they are not supportive of the US coming out of this unscathed. And as much as it's about preserving your independence and your credibility, there's a fine line there between that narrative evolving that, this is a non-democratically elected superpower who are not acting in the US best interest. So I think the politics plays into their decision and honestly should.